Hello and welcome to today's presentation, which is titled Finance Solutions for Home Improvements. I want to start off by just telling you a wee bit about myself and my company, Phil Anderson Financial Services. We've got offices in Aberdeen, Ellon and Caithness. We're independent advisors, whole of market, and what that means is that we research the whole marketplace to find our clients the best possible mortgage that's out there. Unlike the banks, where if you went there, they're tied to just doing their mortgages. The good thing with ourselves is that we research the whole marketplace, all the different banks, building societies, other specialist lenders, and our job is to find the best mortgage that's out there to suit our clients' individual circumstances. We're award-winning mortgage advisors, and I was also the first mortgage advisor in the Aberdeen and Aberdeenshire area to pass the advanced CMAP qualification. So we've not only got good team in place, but well qualified to give advice on mortgages as well. On to the next slide. I want to start off by speaking a wee bit about the various options for raising money for home improvements. One of the most cost-effective ways of doing this is through a remortgage. Now, on the screen, you'll see that it says that you can raise funds up to 85% of the valuation. Since I put this presentation together, I have actually got a lender now that will do up to 90% on a remortgage. So whatever your property is valued at, there's the scope, as long as there's the affordability there and the lender's happy with everything, there's a scope to be able to borrow up to 90% now of the property valuation. One of the benefits of remortgaging is that interest rates are very competitive. At the moment, if you've got maybe about 25% equity in your property, you're looking at rates in the region of maybe about 2 to 2.5%. So they really are just about the best they've ever been, I would say, at the moment. We're also getting some clients opting for 5-year fixed rates just now because the rates on them have been just about the lowest that they've ever been. So one of the advantages of raising money through a remortgage to finance your home improvements is that the interest rates are usually very competitive on that option. What you'll tend to find is that the fees vary quite a lot between lenders. Some lenders will have sort of really good rates, but their fees may be quite high, whereas for other lenders, the opposite happens, and they'll have slightly higher rates but no fees, and that's part of our job, to have a look at the various options to try and find out what suits the client's needs the best. So remortgaging, very cost-effective way of raising money. One of the downsides is that sometimes if you've got a mortgage with one company, there's sometimes a penalty if you come out of it. So again, that's one area that we would always check before we do anything there. Another popular option for raising money is to do what's called a further advance with the existing lender. Benefit of this is that avoids any early repayment charges. So if you were in, for example, a 2-year fixed rate and there was a penalty within the first 2 years, that's a good way of avoiding any penalties sticking with the existing lender. One downside is that, let's say you were 1 year into a fixed rate and you were tied in for one further year. If you were to take out a further advance on, say, a new 2-year fixed rate product, the lender would usually try to tie you in for longer than the initial rate. So quite often in that situation, what we would do is have a look to see if the lender has any flexible options, which means that you aren't tied in then after the initial deal. The rates vary greatly between lenders. For example, at the moment, Lloyds TSB, the last time I looked, their interest rates for further loans were about 5.5%, which is really quite high. They also were charging quite high fees as well. So our job is to have a look what rates the lenders are offering, what fees, and really try to find the best solution for each individual client. One good thing with a further advance is that if you're on a really cracking variable rate or tracker deal, we come across some clients. I had one just recently, they're with Woolwich, and they're on a tracker rate which I think is 0.4% above the Bank of England base rate. So the interest rate that they're paying at the moment is a cracking 0.9%. Now, for that clients, they wanted to borrow more money. However, we didn't want to do a remortgage because they would lose the super rate that they're on their existing deal. So again, what we did with them was had a look at all the various options for raising the money. We decided to stick with the current lender, and we did a further advance for them under that situation. So further advances can be a good way, saves the hassle of moving lender, but to be fair, nowadays it's usually pretty easy to change from one lender to another. Another option is secured loans. With secured loans, you can generally raise up to 90% of the valuation. One of the good things with secured loans is because they're unregulated, the underwriting tends to be an awful lot more flexible. What you'll tend to find is that this is good if someone's maybe had missed mortgage payments, maybe other missed credit payments. Anyone with a wee bit of adverse credit showing on their credit file, the secured loan companies tend not to be quite so strict with their underwriting in that situation. Secured loans are also good for those who've maybe got no proof of income, perhaps self-employed, those maybe on lower incomes. They tend to be able to stretch a wee bit more as to how much they'll consider lending. You can see on the screen there I've put that rates start around 6%. Some of the secured loan rates can be an awful lot higher than that. I've seen some rates more than double that sort of rate. What they tend to do is match the rate to the client's profile and circumstances. One of the downsides with secured loans is that the fees tend to be a wee bit higher on secured loans than they do in normal mortgage cases. Moving on, some of the other options that are out there for raising money. Personal loan is always a good one. Again, if you were tied in with the mortgage, if your lender doesn't have very competitive further advance rates, another option may be a personal loan. Rates tend to be in the region of about 7% starting off there for the personal loans, but you do tend to find most companies generally don't tend to charge any fees, although one or two now are starting to charge maybe a couple of £100 for setting up the loan. Short-term option could be a credit card. Downside with credit cards is that the interest rates usually tend to be very high. You do get some cards where you'll perhaps get maybe a 0% initial rate for a period, but credit card rates tend to be just about the highest rates out there. So that is an option that we would usually tend to try and avoid where possible. And then finally on this page, you'll see that it says lifetime mortgage. Now, this is a specialist mortgage. It's actually one that I can give advice in. You tend to find that there's very few advisors in the local area that can advise on this. Over the years, it's an area that I've specialised in. We do quite a lot of them, and it's a way of releasing equity from the property. So if someone is over the age of 55, we can release money from their home, which they can then use for whatever they wish, but home improvements is one of the things that they could use there. What we tend to find with the lifetime mortgages is there's a couple of different options. There's one where you can do an interest-only mortgage, but I would say the more popular option is what's called a roll-up interest mortgage, where the client borrows the money, and instead of paying a monthly payment back to the lender, the interest rolls up so that over time the debt increases, and generally when the client dies or goes into care, at that point the property is sold, the debt's repaid, and whatever's left goes to the estate. One of the good things is that the majority of lenders do have what's called a no negative equity guarantee, so that's quite a good thing for clients to have. But it is a very specialist area. Anyone giving advice on that has got to have done extra examinations, and that is an area that I can advise on myself. A few other things that we can help with here at Phil Anderson Financial Services. We have access to a lot of local solicitors where we can get discounted legal fees. If you're ever looking to sell a property, we can also get discounted home reports as well as setting up any mortgage or loans. We would also look at mortgage protection, so things like life insurance, critical illness cover, income protection, all areas that are very important as well. Because we're doing a lot of mortgages, we also do quite a lot of home insurance policies. One of the companies that we deal with, very competitive premiums in this area. So if you've got home insurance and it's due for renewal, that's something that we would love to give you a quote for. If you have any questions on the presentation today, the best way is to either email myself, it's phil@philandersonfinancial.co.uk, or you can telephone me. The Ellen office number is 01358 268 166. Thanks very much for listening. If there is anything we can help with, then we'd be delighted to help. For finance, phone Phil. And thanks very much for listening. Thank you.